Hello, I'm Troy Harmon, Chief Investment Officer for Henssler Financial, here with Nick Antonucci and Jacob Keene. This is your market update for January 2019. So guys, lots of negatives in the last month, and the last year actually turned out negative, so we lost all the gains that we had seen.
Yeah, December was pretty ugly. The S&P 500 lost about 9% to drag us to a 2018 return of negative 4.4%, somewhere in there. It seemed like we were going to have a pretty strong 2018 through September, and then obviously it's kind of the situation's deteriorated since then.
Yeah, market lost about 14%, so we were at a high at our peak around 10%.
Yeah,
positive in 2018 on the S&P 500.
And there was a moment where we were teasing a bear market there, but we got the Boxing Day rally.
The Boxing Day rally,
5%
exactly.
in a day.
Santa came late, right?
Yeah, bear market would be a 20% loss from the top.
Right.
Anyway, if you want to get a little more perspective, I know the financial media is just hammering on the fact that we've had all these losses in a short period of time. Has been a short period. We don't invest for a 3-month period. We invest for longer term. You back it up to the end of 2016, include that 21.8% that we had in 2017 with no volatility. You get about a 7.9% annualized return over the 2-year period. Still hurts. I mean, let's face it, losses are not fun.
And I think a lot of focus was put on how much volatility there was the final week of trading in the year. Volume tends to be lighter, obviously. A lot of people out for the holidays, but you had days where you'd see the market sell off 3%, and then we had a day where you'd rally 5%.
Yeah, it was kind of crazy.
NASDAQ rallied more than 5%. Yeah.
The things that we've been talking about since January, where we had a 7% return in the month of January 2018. Bill Lako and I both, at our State of the Market meeting at the end of that month, told you, rebalance your portfolio. It seemed like things were getting a little bit overheated. We remained steadfast in that.
Recommendation to our clients, rebalance, anytime you see the market pull back like this.
Change.
Yeah, you have seen some economics start to deteriorate, though, economic fundamentals. PMIs, as we talked about, both in China and the U.S.
Yeah, China was actually in contraction, and then U.S., we missed our estimates. It's kind of one of the things that we've seen is activity's been strong,
Yeah.
We've been talking, economy still looks strong, consumer still looks strong. These activity levels coming off a little bit, surveys coming off, it's a little concerning, and it kind of feels like momentum's fading a little bit. I mean, we got through that year-over-year comp as far as tax reform goes.
Right.
We're getting into tough comps for both earnings and, again, PMI, those sorts of things.
Well, let's face it, the reason that we get nervous when the economy is so good is because it becomes more difficult to understand how we can get better.
Right.
And we know that any deterioration in the current message actually is a negative for investors who are forward-looking. So, we haven't been alone. There's a lot of folks out in the market talking about they're a little nervous, things are going on. But like I say, since January of last year, this has kind of been where we were, just having seen the market go crazy. And now we're seeing some economic conditions come in that are starting to, unemployment's still absolutely
solid.
Yeah. The employment picture looks great. GDP last quarter, 3.4%. We'll be getting another reading here in the next few weeks. Be interesting to see that preliminary fourth quarter reading for GDP, where that falls in line.
And one of the stories for 2018 with the rise in volatility is we've seen a tightening of financial condition.
Right.
We got, 4 hikes?
Right.
We did, and that last one was really questionable. We talked about that. PCE deflator, which is the inflation number that the Fed uses, was below their target.
Yeah, inflation's really come down.
We got oil at 46 now.
Exactly.
Their dual mandate is what? Keep inflation in check and make sure everybody's got a job.
Yeah.
How could you have better conditions than we had in December, and yet we still have an interest rate?
And I want to get into valuations, but one other thing to mention is we've seen some disruption. I continue to say we've seen disruptions in the credit markets.
Sure.
Credit spreads are widening. You look at the senior loans, these sorts of floating rate loans. I mean, those spreads are also widening. So, again, tightening financial conditions. But with valuations, we talk about PEs, and if we look at the PEs,
looks good now.
Yeah, but
you look deeper.
If you look a little deeper, You look at price to EBITDA, which is going to be, a proxy for cash flows,
Right.
and price to sales, which how much are we selling? Those look stretched.
And these are the things that you can't manipulate like you can price to earnings. The media tends to focus on valuation on a price to earnings basis, but when you have companies just buying back, you have a lower share count. Yeah. Valuations look a little bit more reasonable, right?
And we see profit margins that have been at levels that they've never been before.
Sure.
And I think that's three things. And I think those three things are starting to change. You have one, the buybacks. You have two, very low wage growth. And you have three, low fixed income rates, right? The bond market tends to play into the buybacks too. So you have all of that sort of shifting. So the question is, can they maintain the margins moving forward?
Yeah.
Right. We've talked about it kind of on the margin too, where we think that probably going to see a recession. And I would say in the next 2 years, next 24 months, I think it's a fair call. And it could be self-forecasting as much as just like we're talking about. There's plenty of fear. We're starting to see deterioration. We also saw a Fed that when they made that move, I don't know if you saw the yield curve, guys, but the 1 year Treasury is higher than the 3 and the 5 year Treasury at this point. We have inversion in the middle of the curve. We didn't get that 2 versus 10 that we almost always look for. But the yield curve doesn't look healthy at the moment.
No. One thing I would add is when we talk about the potential for recession moving forward, I think there is going to be a different experience when you talk capital markets as opposed to Main Street. I mean, we had the experience in 2007, 2008, where there's a big consumer deleveraging. A lot of people were way over leveraged. We're not seeing those conditions now. Really, all the leverage is on the corporate side. So it could be what I kind of see as probably like a mild recession from, jobs, consumer type perspective, but something that tends to hurt corporations more than your average.
Sure. And we talk about the Fed and kind of what action they may take in the future. I think this would be interesting. Next week there's a panel with Jay Powell, Janet Yellen, Ben Bernanke. So who knows what kind of guidance you might get out of those three. Certainly it's not going to be guidance, but the opinions and maybe their suggestions as far as Fed actions in the future. I think it would be interesting to hear that panel.
The very first raise we got in this whole cycle back in, 2016?
Yeah.
Janet Yellen, the numbers didn't look like they were there either, the fundamentals for an interest rate increase. She came out and said, well, we're retooling for the next recession.
Yeah.
That's about the only case you could have made for Jerome Powell's
most recent
in December, right? The fundamentals didn't seem to be problematic, and yet we saw an increase in the interest rate. It's been said before, recoveries from recession don't die of old age. Usually the Fed kills them. I believe it's already in the works personally. Jacob, you made the point about the 3 different methodologies for valuation. You look at PE. I've got a model that tells me 2019, if I look at PE, it's going to give us 8%. Obviously, it's not going to be precise, but it's what I've used for a long time. Give me some guidance as to what's going on. If I look at price to EBITDA, if I look at price to sales, it's almost exact, like negative 1.5%, negative 1.2. You start seeing those numbers, you have to go back to basically 2000, tech bubble numbers, before you get in the levels that the price to EBITDA and price to sales were a month ago. So, that's another one of those reasons. It's a little bit scary.
So expected returns are going to tend to be lower, but what you can do, and what we do talk about, is there are stocks that are cheap out there. Not everything's ridiculous.
There are some that just look absolutely really attractive. And that, unfortunately, seems to be some of the ones that we've been beating up most on. Because we were a little early. I'll give you that. We bought some, they were looking really attractive.
The cheap stocks have gotten cheaper.
Right.
The expensive stocks have gotten more expensive.
But if you look in the last couple of months, they didn't continue to get cheaper. And if they did get cheaper, they didn't
finally
get
finding a base in some of those value type names we've been watching for some time.
So there are names to buy out there. We still recommend that you rebalance. If you need fixed income, great time to buy it. All right, so that's been our market update for January 2019 from Henssler Financial. Thank you for watching.